Well, good morning, everybody. March 13th. Thank you for all the birthday wishes. I really appreciated all the kind thoughts. It's amazing how many friends you have, which you don't know you have until you have a birthday, right? So thank you so much.
Yeah. Happy
Um,
birthday, John.
Thank you. And if anybody wants to spend a couple nice hours, Jen treated me to a sailboat ride on out Clearwater Beach yesterday. It was beautiful. It was very, very nice. Bring the sunscreen. Okay.
Oh, yeah.
Anyways, we're really thrilled that you're here with us this morning, and Karen has invited a couple of special guests, and the topic today is basically in general 1031 exchanges. And for those of you who don't know, you're going to know what a 1031 is. And Karen, I thought, why don't, since these gentlemen are colleagues of yours, why don't you, and you know them a little bit better, why don't you
Yeah.
take the reins and introduce them?
Yeah, absolutely. Mr. Barrett Russa is a good friend of mine in my networking group. He is a financial planner and just called me the other day out of the blue and said, "Hey, I got this product." And when he was telling me about it, I was just like, "Oh my gosh!" It automatically, like, all these people came to mind, my customers. And so then we just, it kind of snowballed from there, and we're like, all right, let's do a video on this. So here we are, and I'll let Barrett introduce Mr. Kingsley.
Yeah, so good morning, everybody. Barrett Rosa. I am with IHT Wealth Management. I am a financial advisor, as Karen told you. Most of what I do is retirement planning and investment advisory and so forth. But I had the pleasure of running into and meeting Joe Kingsley, who's on the phone or on the Zoom with us now. He's with Inland Securities. And so the reason that I feel like this is such a great opportunity for you guys is because what this product or 1031 exchange is based around is your clients, family members, friends, yourselves who have a non-primary residence real estate investment and they would like to get out but are scared of the capital gains taxes. That's the crux of this whole thing. Now, Joe is our expert, and I'm going to turn it over to him. He is Joe. Are you still down here in Florida with us, or have you gone back home to Atlanta?
I actually went back last night. So I was in Tampa last week. That's where Barrett and I met. And then my sister is renting a house in Clearwater Beach for the month of March. So my wife and son flew down. My mother-in-law also. We all stayed with my sister on Clearwater Beach this weekend. So
Nice.
actually bumped into Hulk Hogan. So he was riding around in a golf cart. I said hello to him. It's kind of cool.
Awesome. Well, without further ado, Joe Kingsley, he is definitely the specialist in these products and these methods of maintaining some investment in real estate, but not having to deal with all of the maintenance and all the other crud that comes along with investment properties. So, Joe, take it away. Tell us about the DST 1031 exchange program.
Sure, glad to. And thanks, Barrett, and thanks everyone for giving me the opportunity to join you on this call here this morning. It was a beautiful weekend on the beach. The weather was perfect and red tide kind of calmed down for us. So we actually went up to Tarpon Springs on Saturday. That was fun. Had some great Greek food and did a little cruise for an hour or so up there. So nice fun weekend in your neighborhood. So can I share my screen by any chances? Okay. So what I'll do.
Let me make you co-host.
Great.
I got it, Karen.
You got it?
Yeah.
So it's letting me do it. Let me just make sure it works here.
Perfect.
Can you now see presentation?
Yes.
Yeah, John, can you record this?
It is recording. Yep.
Oh, okay, great. So first off, if there's any questions as I'm talking here, please feel free just to stop me from talking. And then there's a couple things popping up, like it'll say admit someone from the waiting room.
I got it.
Oh, you got okay, that. Got it.
Oh, yep, you just worry about your overview.
You just do that. Okay, got it. Thank you. So if you do have any questions, just stop me from talking anytime. So Barrett and I met on Wednesday. Actually, I was doing a lunch for his brokerage firm, LPL, at the Maggiano's in Tampa at West Shore, and we had a good conversation. And then he mentioned he was gonna mention this to you. So I'm glad it all worked out and we were able to connect. So I work directly for Inland Real Estate. I cover the Southeast for Inland. And my role with the company is I work with financial advisors.
This is being recorded.
Financial advisors, accountants, attorneys, realtors, really anyone involved in the sale of real estate. And we provide 1031 exchange options at Inland. I cover the Carolinas, Georgia, Florida, Alabama, and Tennessee, but I'm down in your area, like the greater Tampa, St. Pete area, usually every couple months for a week at a time. So if there's any meetings that you'd like for me and Barrett to attend with you in person, happy to do that. And then we're always available for webinars or conference calls like this too. So Inland as a company, we've been around since 1968. We were founded in the Chicago area back in 1968. And we've managed over 50 billion in real estate investments since our founding. We started out doing multifamily properties in and around Chicago. Then we moved into retail. We became Walmart's largest landlord in the 90s. And then today we really invest in all different commercial and residential sectors. So we'll do investments in residential apartment complexes, also residential build to rent communities, which have gotten more and more popular, where you might have 200 homes that are newly built to rent in a gated community in a high population growth kind of area. We also do industrial distribution centers leased to Amazon. We have one in Fort Myers, Florida currently that we're offering. We do self-storage, senior living, student housing. Actually, not too far from some of you there, maybe, we have a big new complex at University of South Florida in Tampa. There's 811 students in that one, and that one just opened. So we have various different programs. We started doing 1031 exchanges in the 90s. And then in 2001, we formed a different division within Inland called Inland Private Capital that really focuses on that. And today, each year, we do between $1 billion and $1.5 billion in programs for 1031 exchange investors. So we'll have about 30 different deals each year with its own set of properties in different areas, different property types, different lease terms, and so on. We've done about 300 programs now at Inland for 1031 exchange investors. And I know this is probably kind of hard to read, but the average annualized return of all of our programs for investors, so this is a return per year, was 8.75% per year. That includes the income that you get along the way from the program. And then we usually hold the properties for 5 to 10 years and then sell the properties. And the rest of the return comes at that point to the investor. So that's 8.75 per year. And once we sell our property in our program, that investor can do another 1031 exchange and just keep deferring. Keep deferring taxes. If you look at it by sector, we've had some that were above the average, self-storage, healthcare, student housing, multifamily were some of those sectors that had outsized returns. The industrial that we're doing now is a little different than what we used to do. We used to do manufacturing type facilities, and now we're doing big distribution centers leased to online retailers like Walmart or Amazon, or logistics companies like FedEx or UPS. So the tax code itself, this has been around now for over 100 years. So the tax code was written back in 1921 by the IRS. And if you think of just how long ago that was, World War I ended in 1918, and the U.S. was in a recession coming out of World War I. And the IRS really wanted to produce a tax code that would encourage investors that were thinking of selling real estate, not to just sell it and stick the money under their mattress for a rainy day, but to continue to invest in real estate and spur the economy along that way by promoting continued investment from being able to defer all taxes at the time of sale. So you can really do this with any property type other than the house that you're living in. So when the IRS wrote the tax code, they stated that if you sell a property, you need to buy a property that's considered like kind. Well, everything's like kind. So someone could sell a beach house like the one my sister's renting in Clearwater Beach. Someone could sell that and turn around and buy an interest in a self-storage facility. Someone could sell, let's say, raw land that a developer comes in and purchases and buy an interest in a distribution center property. So it doesn't have to be the same kind of property that's bought and sold. Really, everything's eligible other than the primary residence of the investor.
Joe, if I can interrupt you real quickly here, because I
Sure.
didn't know that. When I thought of like kind, I thought duplex for duplex, apartment, et cetera. But what you're saying is an investment property of any kind is basically can be reinvested into any type of investment property.
Yeah, that's right. Definitely. So any kind of property type can be reinvested into any other property type as long as you're not using it as your primary residence. So like a rental home, VRBO kind of home, beach home, that can be sold and exchanged into any one of these kind of sectors. So it's very wide ranging in terms of its use, and it's not limited to the same kind of property type that you buy and sell. So thanks for the comment, John.
Sure.
So if you do this correctly, you can defer all taxes at the time of sale. So there's 4 taxes that are relevant in a 1031 that you get to defer. Number 1 is depreciation recapture. That's the first one. So you can defer that. You can also defer federal capital gain tax, which can be as high as 20% currently. We'll see if it changes, but up to 20% currently. And then if the property's outside of Florida, then you might have state tax liability. Obviously, if it's in Florida, you wouldn't have any state taxes. But other states in the Southeast tend to average 5% roughly. South Carolina, 7%. If you have any clients that are leaving California, that's 13%. If I sell a house out there, New York, New Jersey, 10, 11. So those get deferred. And then the last one that sneaks up on people is net investment income tax. That's 3.8%. So altogether, you can defer about 30% of the value of the property and taxes typically. So very strong tax savings. If you do the 1031 correctly and follow all the rules, all those taxes get deferred. There's 2 things that can cause taxes in a 1031. One would be if you take any cash out at closing, that would be taxable, that part that you take out. Now, a lot of people do that. They might need some cash for something else, some expenses coming up. So they might remove some cash at closing and pay taxes on that part, and then 1031 exchange the rest of the property sale. The other part of it is if you have clients that are selling a property that has a mortgage on it still, then when they sell that property, what happens is the bank will get paid back the value of the mortgage. And then that investor needs to take his cash that he's left with and invest that in a property or a program like ours that has equal or higher debt to equity as a percentage of his sale price. So all you really do there is, for example, let's say someone sells $1 million property and they've got a $200,000 mortgage on it at the time of sale. You take the 200,000, divide that by $1 million, that gives you 20%. So what'll happen at closing is that investor, the bank will get paid back there too. So the investor's left with 800,000, and he needs to invest that in a program that has at least 20% debt to equity within it. So don't get too hung up on that because we can help you through that. All of our programs already have the debt to equity established. So our programs are anywhere from 0 debt for cash buyers, all the way up to 70% leverage for high leverage people that are exiting high leverage properties. So in either case, though, if you take any cash out, that can be taxable. If you don't replace all the debt, that can be taxable too. So both of these things are called boot in a 1031 exchange, and boot causes taxes. So you want to try to avoid the boot and avoid all taxes at the time of sale. So the timing is very important in a 1031 exchange. So before somebody's selling their property, they need to line up an account with what's called a qualified intermediary. That's a firm that's set up to facilitate 1031 exchanges. And they're really an escrow firm that holds the money at closing once it gets sent to them. So what would happen is at closing, when they're selling their property, the money goes right to the intermediary, and then that intermediary holds on to the funds. And at that point, the investor has 45 days to identify replacement properties to invest in. That all needs to be done in writing on a form that the intermediary will provide. So the intermediary needs the addresses of potential properties that the client might be looking at purchasing. And then no later than 180 days after the property was sold, the investor needs to purchase some or all of what he identified on that form. What a lot of brokers, realtors do is they'll list the addresses of our programs. So we'll provide the addresses to you, and you can list those on the form so you have a backup. And then you can look around still for your client, for 45 days to try to find them replacement properties. You can invest in a combination of programs like ours and direct property. So let's say you list our programs on the form just so you have a solution, definitely, and the client won't get stuck paying the tax bill. And then you find them, something else. Maybe you find them a beach house that they want. They could choose to invest in that beach house, but because you had us listed on that form, if you don't find them a property, they won't. Excuse me, boy, my allergies are getting me too. Sorry about that. So if you don't find them a property, then you could use our programs as a solution. So what a lot of brokers and realtors will do is list our programs on that form so that they have a solution just in case they can't find the client a property. And sometimes that will unlock the sale too, because a lot of people will think, well, I don't know if I really want to sell my property unless I know I have a replacement property in mind, and I might not sell it until I find something else, that I'm interested in getting. If you list DSTs, then you solve that problem because our programs are open and they won't be stuck without a property to invest in. So again, that's all done in writing by the 45th day. And if you're identifying our properties, we'll provide you the addresses and the legal descriptions so you can provide that to the intermediary. And then once the client decides what he's investing in, the money goes from the intermediary right to Inland in this case. We'll produce a closing statement, and then their income starts that day, and we pay monthly income to our investors. So income starts right away. The current yields starting out are anywhere from 3 to 4% annualized. That's net of all fees and expenses. So that would be based on their full investment. Generally, 70 to 80% of that income gets sheltered by depreciation from the property. We're buying newer properties and depreciating those, and that shelters generally 70 to 80% of the income from taxes. So if someone's getting, let's say, $10,000 a year in income from one of our programs, they might only be paying taxes on $2,000 of that, and the rest is tax-free income. We tend to hold the properties 5 to 10 years and then sell them. And then once we sell the properties, this whole timeline starts over again. So once we sell a property, then the investor usually tells us to send the money to their intermediary so they can start this all over again and then do another 1031 exchange if they choose to and keep deferring those taxes. At any point in time, someone could stop doing 1031s and pay their taxes. But if they keep doing them, they get to keep deferring and deferring and deferring. And if somebody does pass away while they own an interest in a property through the 1031 tax code, they'll get a stepped up cost basis, which means the heirs won't pay taxes on all the previous gain that was deferred into the program. So this 45-day identification period, I do see a lot of realtors and brokers kind of using us as a backup plan or, a partial solution. Maybe someone's selling a bigger property and they don't want to reinvest all of it into one other property. Our minimums are just 100,000. So if there's extra left on the deal, we can accept the extra part too into our programs. So
Joe, can I stop you for 1 second, please?
Yeah, sure, John.
Go back to the last slide. And I think, because sometimes we don't think across the country, if we have a customer in Florida selling an investment property, we're trying to find them an investment property within Florida because let's face it, we're in the business to help our customers, number one, but also to earn some commission. So on a situation like this, so that's before I follow up that point, the 180-day closing, what happens if there's a delay? What happens if the seller can't close on time? There's title issues for whatever reason. Is there a grace period there for that buyer to not be penalized?
So these are strict timelines that are enforced by the IRS. So the closing does need to happen by the 180th day. If it doesn't, then there would be tax liability.
Okay.
So there have been exceptions to that, like when Hurricane Ian went through Florida and the other states, Florida, Georgia, and the Carolinas all granted extensions to these timelines that expired by March 15th. But these deadlines were extended for people that were having trouble finding replacements or needed more time to close. The IRS extended them 90 days. Mm-hmm. Without an exception like that for a natural disaster, these are going to be pretty much set in stone. If you send the money to the intermediary and you don't identify replacement properties, but the money just went over there, then on the 46th day, you can get your money out of the intermediary account without penalty. If you do identify properties during the 45th day period and you decide not to buy them, then you have to wait till the 181st day to get your money back at the end. But you can get your money back in either case. If you identify, you need to wait 181 days. If you don't identify, then you can get your money back on the 46th day.
And when you say without penalty, you mean without penalty to your firm or, like whatever the charge might be. The fee, they obviously would be, have to pay capital gains on that gain.
Yes. Yep. So there would be the tax liability. Generally, an intermediary will charge all in about $2,000 to $2,500 to set the account up and then to purchase properties out of that account. So you might lose that or a portion of that in a fee, and then you'd have to pay your taxes, the capital gain taxes.
Thank you.
Oh, you're welcome. Thanks for the question. So the structure of these deals are called Delaware Statutory Trust. That's also known as a DST. And we actually worked with the IRS in 2003 to get them to accept DSTs in 1031 exchanges. It's a very investor-friendly type structure. Prior to 2004, if you were doing a 1031, you either had to find your own property or a lot of those programs were called tenant in common or TIC or TIC investments for short. And those had some limitations. So in those programs, the TIC structures, you can only have 35 investors. You can only own one property. Everyone had to get a credit check done personally before they could invest. And then if there was ever a decision to be made, like the sale of a property, when to sell it, all 35 people had to agree unanimously. You can imagine 35 people trying to decide anything. It's really difficult to get 35 people to unanimously agree. With the DST, all that was changed. So we can have an unlimited amount of investors. We've had up to 2,000 investors in some of our programs. So the programs are bigger. They own more than one property in most cases. The investors don't have to go through a credit check. They do need to be accredited investors for a DST. And accredited means either $1 million in assets. Everything counts towards that except your primary residence equity. So if you have rental properties, second homes, that all counts towards the $1 million. And then if someone doesn't have $1 million in assets, they can be accredited by having $200,000 in income for a single filer for 2 years, or $300,000 for a joint tax return. So all those things make you accredited. And then the investor just initials, yes, I'm accredited on the application. They don't go through a credit check. And then most importantly, they don't have to vote unanimously on anything. The manager of the DST makes all the decisions on behalf of the investors. So there's never conflicts of interest between investors that could hold up the sale of a property or some other kind of major decision. 95% of the 1031 exchanges that are done today are done in this structure, unless the investor's buying their own property that they find on their own. Another advantage of this structure is it acts like an umbrella, kind of protecting the investor from anything that might happen at the property level itself. So the DST is an LLC by structure, limited liability corporation, and it offers protection to the investors. Let's say a DST owns grocery stores like a Publix, and somebody slips in one of the aisles, they can't sue the owners of the property through the DST structure. There can never be any liability that flows through to the investor for something that happens at the property level. And then our programs will buy the property first and then open for investment. So you know exactly what's in each deal, and you pick and choose the ones you're comfortable with based on the property type, location, lease terms, income level. Each program has its own properties already purchased. So it's not a blind pool where we're raising money and then going and buying property. It's already in there and you know what you're buying. And then if there is a loan in the program, I know when I joined the call, we're kind of talking about loans a little bit, rates, what's going on. The rates and the loans are already established in these programs. So you know what you're getting in terms of the cost of the debt, the leverage level. If you're selling a property that had a mortgage, you can pick and choose from our programs based on the leverage levels. So you don't have to pay taxes on that boot part that you would otherwise. So it's a very defined investment. This one up on the top, definitely applies in the Southeast and certainly applies in Florida. Vacation homes and second homes qualify. The rule of thumb is you need to rent the property for 2 years in a row before you sell it. And then you don't want to use that property for personal use more than 10% of the time you rented it out for it to be eligible for a 1031. So let's say you have a VRBO rental that you rent for 100 days a year. You wouldn't want to use it personally for more than 10 days that same year in case you were ever audited after doing the 1031. So it's always a good idea if you have clients that own second homes, whether it's a mountain house somewhere or a beach place, encourage them to rent it for a couple of weeks a year to somebody and have some receipts so that when they sell it eventually, they can do a 1031 exchange. The property and the land can be 1031 exchanged. If there's any equipment, let's say it's a farm or something like that, or a doctor's office, and there's equipment, that cannot be exchanged, but the value of the building and the land can be 1031 exchanged. A lot of our investors, like if you look at our average kind of profile at Inland, it tends to be someone in their mid 60s that's, either just retiring, getting ready to retire. Maybe they're tired of managing their properties and they want a passive income stream without having to run around and manage the properties. This can kind of produce that for them, where they give up the management responsibility liability of the property, get monthly income every month. And then if they do pass away at some point, the heirs will receive the value of the program without a tax bill. So you get rid of all the old taxes that were deferred into the program. That steps up at the time of the death of an investor, and the heirs would receive the interest ownership in the program, but without any tax liability from the previous gain. So it's a nice estate planning tool if you have clients that are getting older and they're tired of managing their rental properties, or maybe they have small commercial properties or something like that. They could sell the property, do something like this, get monthly income, and then when they pass away, the heirs will get a step up in basis. And also the heirs don't have to manage the property that the parents owned. Maybe the heirs aren't interested, in managing rental properties. So it can be used as a nice estate planning tool as well. So again, the steps here are the real estate owner sells their property. They sell it to a third party. They don't sell it to Inland. They would sell it to a third party buyer. Then the money goes to an intermediary. And that's the most important part. So if you don't have an intermediary set up, then you can't do a 1031. So you can't take the money, put it in your checking account, and then go do a 1031. It's got to go to the intermediary first. Then you have that 45-day period to identify replacement properties. And once you decide what you're going to invest in, the money goes directly from the intermediary to Inland in this case. We produce a closing statement that day showing their interest ownership, and then the income starts accruing that day, and we pay the second Tuesday every month to our investors, monthly checks. So this is really, if you can see this chart, this is why people have been doing this for 102 years now, the tax savings. So what we're showing here is somebody selling $1 million property. They don't have a mortgage anymore, so they paid their mortgage off. They originally paid $100,000 for that property. And then over time, their accountant had been depreciating the value of the building down. And you can depreciate any building, any structure. You can't depreciate land itself, but any building you can depreciate. So in this case, it was depreciated down to zero. So if this investor does not do a 1031 exchange, this shows his tax liability. So the first taxes due are the difference between the price you paid for the property and the lowered basis of zero. So that's $100,000. That's taxed at 25%. That goes to the IRS. So that's the first check that has to be paid. The next one also goes to the IRS. That's the $900,000 capital gain. That's the difference between the $100,000 price paid and the $1 million, taxed at 20%. So that's the big one, $180,000. Now this wouldn't apply if the property and the investor in Florida. We're using 5.2 as an example. In the Southeast, it's either 0, Florida, Tennessee, or in the 5s on average, or 7 in South Carolina. So we're using 5.2. California is 13 if you have anyone that sold a property in California or is thinking about it. So that can be a factor. And then the last one is net investment income tax. That sneaks up on people a lot of cases, and they don't realize they have to pay it until the accountant tells them that's due. That's 3.8% on the full $1 million. So that's $38,000. So altogether, this client's paying about $300,000 in taxes on his $1 million sale, and he's left with about $700,000. If that same investor does a 1031 exchange, they defer all those taxes. So depreciation recapture gets deferred, federal, state, net investment income tax, and he's got his full $1 million now to go out and buy another property with. So it's a very effective way of protecting people's nest eggs from taxes. And let's say he invests in a DST with Inland, and then 6 years later, the value has grown to 1.5 million, and we sell the property. He can do another one and just keep deferring those taxes and growing his nest egg. And then at any point in time, if that investor passes away, all these old taxes get wiped out. So the heirs wouldn't have to go back and pay any of those taxes if the investor passes away. The income is considered passive. Generally, 70 to 80% of the income gets sheltered by depreciation, which is considered a passive loss. And anytime you match those two things, passive income to passive losses, the extent that you match them to causes tax-free income. So if there's a 10,000 in income coming from a program and the depreciation adds up to 8,000, that investor is only going to pay taxes on 2,000 from the program. We have various programs available at Inland, and we do all of our tax forms this time of year. So 90% of our tax forms have been sent, and the other 10% are getting done this week. It's real similar to what you do if you own a rental property. Our tax form is called a substitute 1099, 1098, and everything is on there that the accountant would need for taxes. So the total income is on there and expenses from the property. If there's a loan, the loan interest will be represented. And then lastly, the depreciation schedule is there too. So the accountant takes all that and puts it on a Schedule E part of a tax return. So I'll pause there and see if there's any questions. And I might have gone over my time too, John. I don't know if we were kind of budgeting in a half hour, but I don't mean to run over either.
Joe, you did great. I think it was just right. And if you could just unshare your screen. There we go. And no, I thought that was excellent. So again, we as realtors, our interest is in our customers, but we also have the bills to pay. So let's say we have a customer who's got a couple $1,000,000 and can't identify a property locally. If we refer them to you, are you a real estate brokerage as well as far as buying these properties? And is it possible to get a referral?
So Inland can't do that as like a third party, but all of our investments, there has to be a financial advisor involved. So someone like Barrett, as a financial advisor, has to be involved in the transaction. We don't sell direct to investors. So I don't know, Barrett, if that might fall more in your kind of area in terms of compensation or referrals kind of back and forth.
So John, with some professions we're able to do revenue sharing. I'm not sure about real estate. So I will look into that and I will let you guys know. Something you said earlier that I want to hit on. You were talking about typically when you guys have investor clients and they're selling a property, they're typically looking for another 1031 exchange. That's not what this is all about. Really, what this is about is the investor that's looking to get out of investment real estate. Mm-hmm. So it's somebody that's maybe looking at retirement. It's maybe somebody that's looking to sell their business and they have some real estate involved in their business. So this is not for your active investment clients, and that's I don't want to put this in as a replacement for that. This is the client, and Joe, you can hit on more of the marketplace for what this is all about than I can. But just why don't Joe go ahead and chime in on that for me?
May I interject real quick? I think I have the perfect example of a candidate. I have a customer that has a home in South Tampa worth about $2 million. They purchased it. They've owned it for 30 years, raised their kids, moved out of the area, has been renting it. And we unsuccessfully were not able to sell it last year. So he rented it again. Had I known this product last year, I believe this would be a perfect candidate because he's older, retired, doesn't want to deal with the headaches of rental anymore. So I believe that's the type of candidate you're looking for, because he doesn't want to, his words to me, I don't even know if I should sell this. I'm going to owe so much taxes on it. And then, you know, he's worried about his legacy, passing it on to his children, things like that. So am I correct?
Yeah, I would say, Karen, that's a great example of a scenario that we see quite a bit of, where someone has owned the property for a while, they're getting a little bit older, they don't want to manage it anymore. The other part of this too would be is if somebody, let's say they sold that property for a couple million, and then they wanted to buy like a small beach place or something, and then they had another 1.2 million left, they could do that part in a DST and get the passive income and still buy a property, you know, for themselves if they want to. You can combine the real property purchases and a DST within the same 1031. So the IRS looks at these programs the exact same way that they look at buying an individual property and doing a 1031. So somebody that's getting a little bit older, that, you know, that they don't want the management responsibilities and they are now in the stage of life where they want more income, a DST can provide that and get them out of the property management arena as well.
Mm-hmm.
So there's also the facility for, you know, if you don't think you're going to be able to find a property within 180 days, there are short-term solutions. Inland doesn't really provide for those. I can probably get you in touch with somebody who would be able to facilitate a more short-term 1031. This is really for a 1031 long-term investment vehicle. Karen, your scenario is perfect. I mean, that's absolutely spot on for what Inland can help provide for.
Mm-hmm.
And usually, oh, I'm sorry, Karen, go ahead.
No, that's okay. Go ahead.
Oh, I was just going to say, the usual safe rule of thumb is if you're buying and selling properties and using the 1031 tax code, you want to own them for a couple of years before selling. It's not a hard and fast rule, but that's what's called the safe harbor rule with a 1031. If you hold for 2 years, it'll never be questioned. I have seen investors sell properties after a year and do a 1031. Now, in the event of an audit, they might need to prove that they bought that for investment use. But if you hold for 2 years, it'll never be questioned.
Mm-hmm. So I have questions on the DST itself. So from what I understand, there's multiple commercial products in there, not just like one big Amazon warehouse. Like, can you explain that a little bit more?
Yeah, sure. So right now we have 6 different programs open, and they have different property types and locations in each one. So the Amazon one that we have has 2 big distribution centers in it. That one has one down in Fort Myers, Florida, and then it's got one in Wichita, Kansas. And the size of those 2 properties together, the purchase price was $275 million. So those are more expensive, bigger properties, and there's 2 of them in that program. We also have one called Diversified Residential that has 3 property locations in it. So it has an apartment complex in Williamsburg, Virginia, and then it also has 2 communities of build-to-rent homes in Phoenix, Arizona, suburban markets. So there's 200 1 or 2 bedroom little rental homes that are really kind of an alternative to apartments. All 3 of those are in the same program. So you get all 3 locations in the one DST. And then on the other side of that, we'll do self-storage DSTs. Now, those are less expensive to purchase. So we might have 10 to 15 locations when we do one of those in various different states and cities. So you know exactly what's in each deal before you purchase it. Like, you can look at the properties within the program and know exactly what's in there. And then what a lot of people do is diversify also. So let's say they're selling a property for $1 million. They might put half the money in the industrial one, and the other half in diversified residential or something like that to get more diversification in different locations and property types.
And when the DST, I don't know if I'm going to be saying this properly. Like, let's say that the Amazon distribution centers are sold, and they're sold at a profit. Is that shared with the investors, the people that invest?
Yes. Yep. So generally about half of our return comes from the income that investors get along the way. And then the rest of that average, and our average has been 8.75% per year. So the other half of that comes from the growth in the value of the property. And once we sell the property, those proceeds go to the investors. And then the investors can choose to do another 1031 exchange, or they could decide to pay their taxes at that point. And the length of the program is typically 5 to 10 years. So the investor really has to think, well, I'm going to be invested for 5 to 10 years in these programs, and then the money comes out at the end. And that's when they could do another one, or they could decide to pay their taxes at that point.
Interesting. And let's open it up. Does anyone have any questions?
I have a question.
Yeah, go ahead, Rachel.
Nice meeting you guys. I've done 1031 exchange. So just not going to invest into DST, this kind of bigger, I'm just giving some normal questions for flippers, rehab, and they do this for a living. And they fix houses, they rent it out maybe for qualification to be 1031 exchange. Does the rental or the rental property has to be rented out for 2 years before they 1031 exchange to the next one?
That's the general rule of thumb with the IRS. So I've seen people do it without doing 2 years, but it might get questioned by the IRS, like if they're ever audited. Okay. So in their guidelines, the IRS will say the safe harbor rule is 2 years. Okay. So you would want to own it or rent it for 2 years or both.
Okay. My next question is, he is planning to continue exchange. He has a few properties and he rents it out for 2 years, and boom, from where he is living now as a primary, he saw something that he would fix or that could turn into a primary 2 years later on. So when will be the time when he paid that capital gain?
So if he, let's say, moves into the property as primary residence, and then he sells that property, if he's still living in it as a primary, then he would owe taxes on it. So you could purchase a property as an investment property and then eventually make it your primary residence. After and not, yes, exactly. That's it. 2 years is kind of the magic number with the IRS.
And I think, and correct me if I'm wrong, Joe, it's 2 of the last 5 years. So you could even move out of the property subsequently, and then as long as you sell it within 5 years, if you lived in it for 2, and then if you move out and you sell it within 5, you still get that primary residence protection.
You do, yeah, you're right, Barrett. So 2 out of the 5 previous years before you sell it.
Okay, great, thank you.
You're welcome.
Anyone else have any questions? This was a lot of information.
Yeah.
I wish I would have known about this about 7 months ago. We did a 1031 and couldn't find a replacement property. So.
Oh no.
Yeah.
Yeah. So this is I would share this with anyone that you think is that, even other realtors that work with investors or 1031. This is just a great vehicle. I remember doing a 1031 and really hustling, trying to find a replacement for my customer. It worked out, but it's a nice option.
And go ahead, Joe, sorry.
Oh, thanks, Barrett. It can alleviate a lot of the stress, around the sale of a property and anxiety. If well, I've got an option with this during the 45 days, so you can identify this. But then you can also look for properties still, for a month and a half. for the client. So it can take some of that stress away, though, feeling like, oh, if I don't find him a property, he's going to pay $300,000 in taxes and he's not going to be happy. You can use us kind of as that backup to reduce the stress of the whole experience.
I don't think you hit on this, Joe, this time around, but keep in mind, guys, you can list as many properties on that form that he was referring to earlier. So if your client really doesn't have anything in mind, you can go ahead and get in touch with me, and I'll get in touch with Joe, and we'll get, you know, however many properties you want to put on that form while you're looking during that 45-day period, and then you can add that property in if you end up finding something. That way you've still got an out. You've got a way of protecting that 1031 umbrella.
Yeah, that's a great point.
Another quick question. So what would you guys normally charge? Because a lot of people asked. I think I went through 2 different 1031 exchange company, and they charge a little differently. So I'm just at least wanted to give my client some information before I send it to you guys.
Sure. Go ahead, Joe.
Sure.
You know better than
Yeah, sure. So the total fees on the front end, and this includes Barrett's fee, Inland's fee, and Barrett's brokerage firm fee. So generally, they're up to 8.5%, 8.5% maximum fee for the investor. That doesn't show an investor's statement in any way. So if a client writes a check to Inland for $1 million, the statement will show $1 million, and the income is paid on the $1 million. But in reality, between Barrett's firm, Inland, and Barrett, there's 8.5%, up to 8.5% on the front end. That includes everything. So like if you compare it to someone buying their own property, where there's the broker, the attorney, you know, closing costs, fees, expenses, it can be comparable to closing of individual properties. It doesn't show on a statement, but that's really what the investor is paying upfront on their investment.
I would liken it to if your client buys a bond, if they buy a $10,000 bond, they get a $10,000 bond and their statement says $10,000. Inherent inside of that transaction are fees, but the client doesn't actually feel that. It actually is built into the expense ratio within Inland's income statement.
Okay.
And Rachel, we'll give you, Barrett, why don't you share your contact information so everyone can write it down, and then feel free to reach out to Barrett or Joe with any questions on these, okay?
Okay.
So why don't I send you all of my contact information, Karen, and then can you disseminate it for me?
I absolutely will do that.
All right, good. I'll go ahead and give you my phone number. It's 813-692-1342. And I think everybody can see my name on the screen. It's a unique name. So I'll give you the phone number again. It's 813-692-1342. You know what? I messed that up. My office number and my cell number are pretty close. It's actually 693. So let me give it to you last time. Sorry. 813-693-1342. And if I can't answer your questions, we can get Joe on the line, and he can give us the more specific. Thank you for that, Karen. Get you the particular info and everything.
Yeah.
And I can do the same too, Barrett, if you like. So my cell number is 224-361-1226. I live in Atlanta, but Inland's based in Chicago, and our phones come from Chicago. So that's why it's a number that you might not recognize, the Chicago area code. But if anyone would like to call me anytime, you know, glad to talk. And what I'll do, Barrett, is I'll send the information to you, all the client approved material.
Yeah. You
could forward that to everyone on the call. And if anyone on the call wants to use that information with a client, that's all registered information. So you can use that as like an introductory piece to the conversation too.
Wonderful.
Good stuff.
Wonderful. We'll get that out to everyone and share it.
Any other last questions?
Any last questions? Anyone? All right. Well, thank you. Thank you very, very much, both of you, for being here and sharing this information. We really greatly appreciate it.
John and Karen and everybody else, thanks so much for the invitation. You guys have a great rest of your week.
Thank you.
Thanks, everybody. Nice to meet you. Have a great week.
You too.
Thanks.